The second financial statement that we want to talk about is the income statement. And if the balance sheet is a picture, a historical snapshot of the firm's assets and liabilities at any given point in time, the income statement is a movie. It's a moving picture, and the movie tells us how we moved from the items and the values on one balance sheet to the next. Right? So if we think about just the annual balance sheet, say from 2019 to 2020, all kinds of things on those balance sheets are going to change. The income statement is the way that we understand how those things actually changed. How much cash did we have? How did our accounts receivables and accounts payable change? How did our assets and other liabilities change? The income statement helps us understand all that. And because the income statement is a movie, at the end of every reporting period, the income statement gets wiped clean and then starts all over again. So the income statement moves from revenues through expenses all the way down to profit and retained earnings. And we close the balance sheet and the income statement at the same time. We report the income on the income statement to the balance sheet in terms of retained earnings and cash. We adjust any of the other items on the balance sheet that are relevant, and then we restart the income statement from the start. So 2020, when we start 2020, the revenues start at zero, and the expenses start at zero, and we start all over again. Okay. Now, one of the big issues from a financial manager's perspective is that GAAP rules have a couple of things on the income statement which causes the income statement not to reflect cash specifically. For the most part, it's because of something called accruals, but the other big item comes from depreciation. Okay? So let's take a look at a really simple income statement. Now, I expect that this is nothing new to you all. I would expect that on an exam, you would be able to write a simple income statement just like this. In fact, you'll see some examples in the homework problem where I expect that you're able to fill out an income statement like this, or at least fill in the missing pieces. Okay, so this is going to be really important. We're going to use income statements a lot in the later parts of the class. So I expect that this is, if it's not fresh in your mind, that you go back and refresh it. Okay? So an income statement, we start at the top with what we call net sales or revenues. Right? This is all the money that the company earns in a given period from operating the firm. Right? Selling the product, selling the service, any money that we make gets combined into net sales or revenue. Then we subtract any costs that we have. So typically this is going to be, say, cost of goods sold. Cost of goods sold represents all the costs associated with building the product and selling the product, but it could also include other costs, anything like that. And the items might be separated, so you might have cost of goods sold and other administrative costs underneath it. Then we subtract depreciation, which is an accounting term. Depreciation is a method to slowly reduce the value of the assets on the balance sheet so that they more accurately try to reflect market value. And sales or revenue minus cost minus depreciation gives me what we call EBIT, or earnings before interest and taxes. This is our first level of profit, our first measure of profit or income. Right? EBIT is what we often call operating profit or operating income. And that's because it only reflects the revenue earned by the firm minus the cost and depreciation of operating the firm. It doesn't include some of the other financial and taxable items down below. So EBIT then, the next thing we subtract is interest. Notice that earnings before interest and taxes describes the rest of the income statement for you, because this is earnings before you subtract interest and before you subtract taxes. And so the next thing we do is subtract interest. And we see that interest paid, this is money, interest is specifically the cost of having debt financing as part of our capital structure. Gives us taxable income, which is sometimes, or maybe more often, called earnings before taxes, or EBT. And again, that describes what needs to go next, and what needs to go next is that we subtract taxes. Now, taxes in the US are a flat 21% now, so this is a little bit old of an income statement. I should probably update it so that it has the more appropriate tax rate for corporations. But we subtract the taxes that the company pays, and whatever's left is called net income, or profit, or just simply earnings. All three of those things represent the same thing and mean the same thing. So they get used interchangeably, and that's something you really got to be careful. Watch out for. Okay, it can be confusing. Particularly can be confusing all the different levels of earnings. Earnings before interest and taxes, earnings before taxes, and just plain earnings. Now, net income then gets split. This is profit. There's no more cost to be borne. Part of the profit gets split into dividends, which is the payment to the firm's shareholders. If you're an owner of the firm, one of the things that you have as a right as an owner is you get a claim to some of the firm's profit. You get one share of the profit, and that gets paid out as dividends. And they get paid out every quarter or every year. And then whatever's left, the firm adds to retained earnings. And maybe actually the decision-making process from the financial team goes the other way. The financial team decides first, how much should we add to retained earnings? Do we have enough money in our savings account for if we have something go wrong? Do we have any big investments that are coming up that we want to save some of this profit for, so that we don't have to turn to equity or debt as our capital sources for a new investment? Then, once the firm is satisfied that those requirements are met, we use dividends or we pay out dividends to shareholders. Now, what do we care about from the income statement that might be different than the way that you learned about the income statement from accounting? First is all these different measures of earnings, right? We are going to care very specifically about what we call operating income, right? Which is EBIT or EBITDA, depending on how much depreciation and amortization the firm has, right? And that brings us to depreciation and amortization. There are some differences here. Again, depreciation is an accounting rule. It allows us to try to match the cost and revenue generated by an asset, and to hopefully try and reduce the book value of the asset to be more in line with the market value over time. Now, a couple different methods of depreciation. The two allowed and used in the US are called makers, which is a modified, accelerated cost recovery system, and straight line depreciation, which is even depreciation over time. And hopefully you've learned some about that in accounting. We'll spend some time in a later chapter working some depreciation examples, talking more about it, because it's pretty important. And then what we ultimately want to do as financial managers is slightly rearrange the income statement so that it provides a more direct measure or a more direct picture of how the cash moves through the firm. Because there are a lot of things on the income statement that are non-cash expenses. And the big ones are depreciation and accruals. Right? But there are other things in there that we when we're trying to get an idea of how much cash the firm has and how that changed over the year or whatever the reporting period is, that we're going to want to remove. So mainly what we're going to use from the income statement is we're going to try to look for a measure called operating cash flow, which is an adjustment to operating income to make it so that the operating income is only operating cash income and does not include any non-cash items. Okay. And that brings us to sort of the third financial statement, but maybe the more important thing for us in this class, which is that we are not going to use the traditional accounting cash flow statement, but we are very concerned with cash flow analysis. And so we're going to sort of make a new cash flow statement in this class. And we're going to use that when we analyze decisions and when we analyze investments. Okay? And we care a lot about this as managers because this is one of the central sources of financing for the firm. In fact, it's the cheapest and the most readily available, and probably is the first one that we look at. We want to know exactly how much money the firm makes, spends, and saves. And we don't want it to be distorted by any measures that aren't representative of actual cash changing hands in one of those ways. And that means that we have to adjust the items in the balance sheet and the income statement slightly so that we can get a better picture of what's going on. And remember that this is all down to liquidity. You can think about a firm in the business of managing liquidity. They have to have illiquid assets that they operate in order to run the business, to make and sell product. And then they have to have illiquid assets that they then save as precautionary savings, as cash that they use on a day-to-day basis. And this tension between those two things is very central to the operations of a firm. So it's really important to the financial management team to have the clearest picture of that because the tension is central to the business.